What's everybody? What's up, everybody? Sorry, it's my AirPods getting me all confused. We're back again with another episode of the Bulletproof Dental Practice Podcast, and we're stoked to have our good buddy Brannon Moncrief, repeat guest, repeat offender
Like
on the BP podcast.
three time, maybe 4 time even. I don't know. Record time.
We're excited to have you back as this year's guest listener. But we, all kidding aside, we were just talking before we hit record, and Brannon, you were saying how what you're seeing in the landscape, and I was joking around. Were you just on my last call with the dentist? Because it's exactly what you're seeing and what I'm seeing are coincident. And it made me think, did someone just blanket every dentist with this one message like 10, 15 years ago to go out and buy as many possible practices as you can without any regard to system, strategy, profit, or any vision whatsoever? Did I miss that message? Because it must have gone out to every single dentist.
Apparently so. I think scaling without intention, right? We're having a ton of conversations with people that have 3, 5, 7 locations. My next question is, what's your top line revenue? And oftentimes it's, I've got 7 locations with 9 million in top line revenue. Well, I can tell you right then and there that your EBITDA probably sucks because you don't have the revenue you need to run efficiently. You're not going to be looking at a 20 to 25% margin. You're going to be looking at a 8 to 12% margin.
So here's what I think happens, by the way, and then I just want to give you my opinion. So, and this is, what are you giving me that look, Peter? Are you just mad about my AirPods and the voice performance?
No,
I just saw you
no.
like sigh and gave me like a screw face. Here's what I think happens, guys. A dentist gets out of school and becomes amazing at what they do. Right?
Okay.
Why are you messing with me, Pete? They get
amazing.
They're amazing at what they do.
I'm on every word you're saying. Keep going.
And then what happens is they believe somehow that the dentistry they provide and the patient skills that they have somehow translate into them being an amazing dentist entrepreneur. So they go out and buy practice number 2, and that can actually work out okay because they can drive back and forth between 1 and 2. And it furthers their theory that they're an amazing dentist entrepreneur. And then they go to 3. And then that's when it gets a little tricky. And they are realizing that location 1 makes a lot of money. Location 2 might be breaking even. And location 3 is actually draining all resources. So then, and then you know what comes next, Craig, right? You know what comes next, Peter, though, at the end of that?
The culprit, though, I think is some, I think podcasts and forums and things like that are to blame, quite honestly, because we hear this narrative, because where else is the narrative going on? Even probably some conferences, is that you hear this narrative is that, oh, private equity is looking for multi-locations, right? Looking for a platform, looking for this. And so, Brannon, to your point, it's like, oh, okay, I want to build it, build with the end in mind and build multiple locations without the intention of the economies of scale, right? It's just it's the own internal duct tape roll up that we hear about, where it's just a bunch of aggregate disparate practices. For example, I had a call with someone just maybe 2 months ago, and they're like, yeah, we've got like 12 buddies who want to get together and go to market. And I go, and I was really nice to these guys, but I was like, guys, this was like so 2015, 17 strategy. This will not work. Like, they will see through this house of cards. And if you're not savings and showing where they can have an arbitrage of the economies of scale, the things that you've done, like no one's coming to the plate to be like, oh, look at you guys holding hands together kind of thing. Let us give you a massive multiple. Like, it's not happening. So anyway, Brannon, you know more about this. You've forgotten more about this than we probably know. So let's let you talk.
Yeah, well, I think your point is well said, in the sense that there has been this misnomer that more locations is equivalent to a higher valuation or more demand from strategic and financial buyers. And that's not the reality. More locations comes with more overhead and comes with a lot more management burden, the need to create centralized infrastructure, and that erodes EBITDA.
But let me put a pin in that, not to interrupt you. Put a pin in exactly what you're going to say. My apologies. But doesn't it help, though? Couldn't you get a few points of attractiveness for distribution? Let's say someone wanted to come in and take over a metro area. So if you had a head start with a distribution, you might get some your poor
So
EBITDA
Pete,
might get some consideration because you have a higher run rate potential.
so like losing money over 5 locations is better than losing money over
No,
2
I'm
is
not
what you're
saying I'm
saying.
not saying losing money, Greg, but I'm
Because there's
saying like we all know
distribution.
this. We all know this from what was the one that happened, and this is common knowledge now. Like the DECA valuation, right? Remember when it was a 17x, we heard, oh, it was the highest multiple in dentistry. Well, that's because there was a lot of new stores coming out of the ground, right? And they hadn't had a chance to have attribution, so that blended EBITDA made it bigger because they weren't because those other stores weren't contributing, kind of thing. Isn't that right, Brandon? Am I saying that right?
Yeah, look, all other things equal, more locations will end up in a higher valuation, more demand, and a
There
higher
you go.
multiple,
Well said.
right? But oftentimes what happens is we're comparing a business with 2 or 3 locations, top line revenue of 10 million with EBITDA of 3 million against a business with 7 locations, top line revenue of 10 million and EBITDA of a million, right? I would much rather invest in the business with 3 locations that has proven that they have the systems and talent to grow and replicate that model, and take it from there rather than partnering with somebody who's proven that, great, you've got more storefronts, but you're not operating efficiently. You don't have the right talent. You don't have the right systems. That business is going to be harder to scale. So I think you've got to build with intentionality.
Yeah.
Don't go to location 2 until location 1 is successful and profitable. Don't get to location 3 until locations 1 and 2 are successful and profitable, where you've actually got the talent, actually got the systems, actually got the economies of scale in place to scale the business meaningfully. That's what leads to accretion, higher valuation and more demand, more storefronts. The number of locations barely moves the needle on the multiple and the valuation comparative to the EBITDA itself. Private equity is not looking for locations. They're looking for EBITDA. They're looking for systems. They're looking for sustainability and scalability.
So you had 25 meetings you kind of alluded to before we hit record at DEO, right? Because you're very connected to the buy side, right? The private equity that has the money that's looking to buy dentistry. So what is an attractive percentage? So we're talking about EBITDA again, right? You've mentioned that a couple of times. What are they seeking in terms of what's a good EBITDA as a percentage versus what is something that's bad, right? And do you know what I'm saying by that?
Oh, yeah.
EBITDA as a percentage of your top line revenue.
Yeah. So we stay in very close contact with the buy side, right? We represent the sell side, but we have to know who has money, who's buying, what they're looking for. We're constantly gauging that appetite and attributes that they're looking for. So typically you're looking at healthy EBITDA margin, 20 to 25%, right?
Okay.
If you're lower than that, that means that you're either don't have the size to leverage economies of scale, you're not operating the business efficiently, maybe you're too spread out among multiple locations and you're carrying too much occupancy costs, too much staff costs. It's also important to talk about if you're higher than that. So if your EBITDA margin is higher than 30%, let's say, a lot of DSOs and private equity buyers will look at that as potentially being unsustainable, right? What are you doing that's allowing you to operate at such a high margin? And it may be that you're understaffed, that you don't have the infrastructure, the systems, the talent you need to continue to scale that business at the clip that you've been scaling at. And that's eventually going to catch up to the buyer at some point. So they may actually lean back a little bit on your valuation and your multiple if your EBITDA margin looks unsustainable.
So there really is a Goldilocks scenario, right?
Yeah, the sweet spot, is truly in that 20 to 25% range.
Okay.
If you're below it or above it, you've got to make sure that you go to market with a succinct narrative regarding why you're below or above it and why that's going to be a good thing for the buyer long-term, not a bad thing.
Yeah. So the take-home message, if you're listening to this, is 25%. If I was hearing that, I'd be like, that would be my goal. That would be my, what I would calculate. And Brandon, at Bulletproof, we talk about KPIs and all these things like that. And Craig and I always say, like, look, new patients and top line revenues are great KPIs and average production per patient visit. But the ultimate KPI in this scenario of operations is your EBITDA, right? Because that's the prognostication of what your business is worth based on a multiple. Right?
Every conversation regarding value starts with EBITDA, nothing else.
Right. Right. Not how many employees, not how many new patients, none of that. And those are all great. Obviously, they flow up to potentially the EBITDA. How do you? I mean, it seems like this ethereal thing that people talk about, right? Matter of fact, Craig and I got a text today about someone who wrote a book about EBITDA, right, and how to kind of do it for dentists, calculate it. How do you recommend people do it without going through a quality of earnings and a full thing? How do you recommend that people establish their own baseline just to know where they're shooting from in the dark?
Yeah, I mean, that's where we always start the conversation, is to do a deep dive, do an EBITDA analysis, do evaluation, and really quantify what do you have, right?
Yeah, but you're doing that for people to potentially go to market, right? Who are interested in selling. I'm saying, how does someone say, look, I'm 5 to 10 years away in my own head
or I want to take on a partner,
or like, how do you recommend? Because accountants really don't do that stuff. And if you have your accountant do it, I assure you, almost with I've never seen a CPA do it correctly in my world. Now, I'm not saying they can't, but it's a different skill set.
I agree. If you gave your numbers to 10 different CPAs and 10 different DSO buyers, you'd get back 20 different EBITDA figures. We actually do quite a few valuations, quite a few EBITDA analysis well in advance of a potential sale, just to give somebody a baseline as to, where are you at today? Where are your blind spots? Where do you see areas for improvement, and where are you trying to get to before you look to monetize the business? And how do we reverse engineer that goal? So at any point in time, we've got 20 to 30 doctors that we've done valuations on, and we're rolling forward those numbers every 6 to 12 months, and keeping track of them and then coaching them. Do
you do that complimentary?
We do,
because we have a ton of people that are always asking us, like, how do you guys do it? And Craig and I have access to different people, so we kind of know it. But like, is that something that you would do? Like, if someone was, like I said, I'm not interested in selling right away, but can you help me with a baseline? Is that something that McLaren and Associates can help with?
Yeah, we typically charge for the initial valuation, nominal fee, depending on how many locations, $2,500 to $5,000.
Okay.
And then we typically update it twice at no cost. And then we'll charge a nominal fee, not the full valuation fee, as we go forward from there. So sometimes with clients, it's every 6 months. Sometimes it's every couple of years. But we love to establish that relationship early, because you're right in the sense that whether it's CPAs, consultants, whoever it may be, they often peg the EBITDA figure incorrectly. And that is also the number one way that private equity and DSOs are predatory. When they go to buy a practice, they'll dangle the carrot of a sexy multiple, but they're undercut you on your EBITDA by
100%.
10 to 20%.
So you spoke about, I think the market for dentists looking to go to market has been pretty dismal in the past couple of years based on interest rates. And we all know that the cost of capital highly influences your valuation from a dental practice, right? And with interest rates being so high, what are you seeing? Your ears to the ground on this. What are you seeing from a macroeconomic climate in the next, let's call it 12 to 18 months? Could it be a potential good time to consider a transaction?
Yeah, let's kind of back up. We'll kind of talk about where we were at post-COVID, where we were at over the past 24 months, and then kind of where we're headed. I mean, obviously, all of us in this space understand that the market was frothy, white hot coming out of COVID. Valuations increased by 30, 40% in many cases. Practices that were selling for 6 times EBITDA pre-COVID, selling for 8, 9 times EBITDA post-COVID. Macroeconomic conditions were ideal, low interest rates, money was cheap. It was very easy to get your hands on it. Banks were lending. But as macroeconomic conditions changed rapidly, interest rates doubled. Most DSOs now borrowing money at 12 to 15%, as opposed to 5 to 7%. And then banks tightening up, not offering as much leverage as was available to get these deals done previous to these interest rate changes. It caused a lot of DSOs to find themselves, over levered, some of them in the red from an operating standpoint, because you have to understand how a DSO functions at scale. If your practice level EBITDA margins, let's say 23%, and then you're carrying 7% in operating cost at the DSO parent level, all right, now you're operating at a 16%, 17% margin. Interest rates go to 14%. Now your margins are razor thin. So that's where the conversation regarding same-store sales growth became so critically important, because if you're buying practices and they're moving backwards and you're at a razor-thin 3% margin, you're going to find yourself in the red really quick when interest rates go up to 13, 14, 15%. As a result, a lot of DSOs pulled back. They were either over their skis operationally or from a leverage standpoint. They went to the sidelines. They were replaced with smaller emerging DSOs that more recently took on private equity capital and still had powder available, to spend with their banks. So the market over the past 24 months, I would say, has not been dismal, but it's been different. The mix of buyers in the marketplace has been different. A lot of the legacy buyers, the larger DSOs that were out there acquiring practices a few years ago, on the sidelines, smaller emerging buyers stepping up to fill that gap. The thing that changed the most was actually not the multiples. It was the demand and the scrutiny on the quality of the assets that DSOs were acquiring. So if you had a multi-doc business with a great reputation, even a margin of 25% and revenue 3 million plus, the demand and multiples were there. So still seeing practices trade at 7.5 to 9 times EBITDA if you check all the boxes, right? But if there's some hair on it, maybe it's not a desirable geography, maybe not a great reputation, maybe the primary producer is looking for a shorter exit or expects 80% cash at close. Not a lot of demand, definitely compression on the EBITDA multiples when we're talking about those assets.
What's a shorter exit? Just a curiosity.
Yeah, so anything under 3 years is going to be problematic in most cases. So that was a big pivot about 4 years ago, 5 years ago that DSOs made. So traditionally speaking, looking for a 2 to 3 year post closing commitment, but that came with serious guardrails, right? You got to work a certain number of days a week, days a month. You've got to produce at a certain clip. DSOs have gotten wise to the fact that doctor turnover, in particular founder turnover, is their Achilles heel. They often see the practice move backwards once the founder exits. So they've extended that post-closing commitment, but it comes with more autonomy. You actually don't have to work a certain number of days a week or a month. You don't have to work chairside. They just want somebody vested at the local level that knows the business and has a financial interest to keep it operating same or better as it was.
Not many people know this though, Brandon. In my experience talking to dentists, they think it's still the world of like dentist to dentist transaction. Like, oh, you bought my practice, therefore I'm leaving. And then, oh, I'll go to private equity with a bigger valuation. But to your point, it comes with typically 3 to 5 years of not handcuffs, but like, let's call them golden handcuffs, right? There's some autonomy, but the deal is predicated on you sticking around. So back to my question about, hey, I'm not ready to sell yet. You want to keep in your eye, okay, but when you are ready to sell, it means that you're probably ready to walk away. So be thinking in a timeline of 5 to 7 years ahead of when you think, right? Because
that combined with knowing what buyers are looking for and what they find valuable, because that's constantly evolving. I mean, 5 years ago, I could sell anything to anybody, right? But because of the change in macroeconomic conditions and because there's some blood in the water, DSOs, private equity's gotten smaller as it pertains to dentistry and all the different verticals that they're investing in. They become smarter investors through going through the cycle that we just went through. So built to sell.
Stupid money makes stupid policies. But you said something before you jump into built to sell. You said there's blood in the water. So I imagine there are a lot of DSOs that acquired really shitty assets along the way. What's going to happen to those people? What are going to happen to the larger DSOs that promised their affiliates, hey, don't worry, in 24 or 36 months, we're rolling again and you're going to get a massive return? What happens to those guys? There's some big players out there that have had that narrative. So what do you think happens?
I mean, look, like any industry, especially an industry where there's major private equity involvement, right? A handful of the companies are going to zero. A handful of them are going to fail, right? A handful of them are going to get a unicorn result, 27x return on equity over 3 recap events in a 12-year period. There's a handful of DSOs out there that have gone down that path. And then everybody else is going to fall somewhere in the middle. Look, I think the days of 5, 7, 9x return on equity in a 5-year recap cycle are gone, because the macroeconomic conditions are going to improve, but they're not going back to where they were 3, 4, 5 years ago. So now,
in plain English, so the listener understands, we will not be seeing rates. You will not be borrowing at 2 and 3% again, or 1.5.
No,
for the listener.
Possibly never in our lifetime.
Yeah, that's what I was hoping you'd say. I actually believe that as well.
that was an anomaly. We've all heard the stories of our parents that, they walked 15 miles uphill in the snow to school and they bought their first house at 23% interest, right? Now, we're not going there, but we're not going back to the days of free money and stupid money. That has left our environment, and it's really left, the macroeconomic environment.
It sucks because so many of us are so used to that. So many of us are so used to that.
Tactical takeaway tip from that: if you have any loan right now that's 5% or less, don't prepay it. Or would wouldn't that be fair to say? Like, everybody feels really good. Like, I have this $1 million loan. It's at 3.5%. It's just pissing me off. No. That's free money. Because 3.5% at the end of, after taxes is 65% of 3.5%. Because you're saving the tax on the it's coming off your adjusted gross income.
Well,
yeah.
You've got the interest write-off, and then I'm a finance guy, former banker. You always have to keep in mind, when you have debt, you're paying simple interest on a declining balance, right? When you're investing, you're earning compound interest on an increasing balance. So it's not just the interest rate gap, it's the arbitrage gap as well. That's massive over time.
Great point.
It really is a good point. Unfortunately, I think that time period, for so many of us who were in business at that period, we are romantic about that era, thinking it's coming back. And you're like, I'll just wait, thinking that's the return to normal. And like you said, Brandon, and Craig and I have said this, it's never coming back. So stop being romantic about it. Establish that interest rates are probably going to remain in the 5% range, plus or minus 2, well, plus 2 potentially, like between the 5 to 7 range for the remainder of your lifetime.
Yeah.
Right.
Yeah.
And then function your models around that, meaning, can I afford this? Can I build this? Can I invest in this? Function your models using that as a kind of a simulation versus I'll wait till I get cheap 3% interest rate again kind of thing, because it's not going to happen. Not going to happen.
In combination with, build a real business. Build a sustainable business that has value today and will have value 10 years from now, 20 years from now. If you do that, at any point in time, life happens, priorities change, you'll be in the position to monetize it at a good valuation. If you don't do that, if you're playing the short game, I'm going to aggregate a bunch of practices and flip them. I'm going to do a roll up and wrap my arms around 9 of my buddies. We're going to go to market and get a 15x. You are going to be very, very disappointed. And don't buy into the narrative that some people out there are pitching, that you can do a roll up and don't worry, doc, we're going to get you 15x. It's going to take 2 years. Pay me $250,000 in fees along the way.
Take a percentage of their dog shit stock that they're doing, meaning like this private stock, like, hey, we're doing a new thing and you can have, we're going to give you 30% cash at close and the rest is going to be in equity, right? And then that equity goes to zero, right? You're sitting there with your whatever in your hands. So
a lot of that out there still, even though the dumb money has left the market.
I love what you just said, Brandon. I want to just kind of double click on that. You said build a real business. And I think that most dentists don't understand that. So a real business, I think if you make the decision to start your own practice, you have, by virtue of drawing that line in the sand, you have now agreed that you're going to make this a real business. Because the incremental profit of you being a solo doctor in your own business is so negligible for the amount of time you have to do with your hygienist and payroll. I mean, what are you going to get? A couple extra points, 3-4 points more than an associate? So I almost feel like if you're going to start your own business and be a solo provider, you have to scale it to at least a certain level where it is a, quote, real business. And what do I believe a real business is? A real business is one in which if you as the dentist stop working, it can still survive. So for those people who have 3 and 4 locations, who are traveling to most of them and producing the dentistry that makes it profitable, that is not a real business. If God forbid you're skiing and you break your wrist and you're out of business for 3 or 4 months, if it cannot survive on its own, that's a scary position to be in. And I think if people were intellectually honest, they would say most people don't have real businesses, Brandon. And you see that, don't you?
Oh, all the time. I think that's where EBITDA comes into play, right?
Right.
EBITDA is a prerequisite for having what you're describing as a real business. That's the benefit of ownership above and beyond what you would make doing that same dentistry as an associate. And that's really what drives value when you look at a business.
There
But
you
the
go.
issue is for dentists, they can have fake EBITDA because they work for free. So the $1.2 million of dentistry that they do, they don't have an associate salary for that.
Meaning it's
It
all
flows
blended in the take home is
It's
what you're
all
saying,
blood.
Greg.
I mean,
Yeah.
that's what I see most frequently. I know you
Yes.
see more P&Ls than I do. But people
Nothing,
tell me my overhead's 30%, I'm 70% profitable. I'm like, amazing.
nothing
What do
worse.
you,
Yeah, when you got to tell somebody that makes $1 million a year that their baby's ugly. But the reality is, even though their income's incredible, they're amazing producers, they have no EBITDA when you factor in a market wage because they're a super producer. And they're like, what do you mean my business doesn't have value? Private equity, DSOs would not want to buy me. I make $1 million a year. And I'm like, look, you're super successful. You're a hell of a dentist. But from a business perspective, your business does not have value outside of you.
And let me break this down a little further for people who don't understand it, because the cost of that replacement, your cost of labor replacement, because you're the super producer, your cost of labor, if you get hit by the bus, like that's what I was saying, that key man risk, and that's how they have to look at it. The cost of replacement is abated from that take home from them, right? Meaning, you get what I'm saying, right?
Yeah.
Yeah. That's so funny. Your baby's
or
ugly.
you have that super producer that does 2.5 with his own hands, and he wants to sell to Dr. Junior. And Dr. Junior does not do the scope of practice that Dr. Badass does. So Dr. Badass is doing all in X and crazy surgeries like, hey, I got a $5 million practice here. It's amazing, Dr. Junior, buy it. And Dr. Junior can't do that stuff. So we don't speak the same language in dentistry. So it's incredibly confusing. And what compounds this narrative even further is we all know 4 years ago, there was a super producer that had key man risk, that was the entire practice with his own two hands, and he got paid an 11. Just literally 4 years ago, 3 years ago. I know that guy. I actually know an orthodontist in my area that got paid an 11, 80% cash up front, solo provider. Guess where he is now? He's in Italy having fun. And the private equity is like, what the F just
Where
happened?
is he?
Where is he?
Yeah, they've learned those lessons. They're not
True story. But that was just 36 months ago. So
I
Dr. Jones got it. Brandon, why can't you get that for me?
Yeah.
I know those stories. And the reality is this, those DSOs that were making those offers and buying those assets are the ones that are in trouble and are on the sidelines right now. It's kind of a funny back and forth we have with a lot of our clients. You want your buyer to be completely irresponsible on your transaction and give you these crazy ass terms. Hey, doc, you can walk at close. You're going to get 90% cash at close. We're going to give you a 10x multiple. But then if you're going to have equity in that company at all, you want them to do the opposite on every other transaction they do
Right.
side of your realm. We all know that's not practical.
So funny.
Right? So if you have a buyer that's being irresponsible, that looks far different than any other offer you have. If you're going to have equity in that company, you should be leery that they're being irresponsible in every other transaction, and your equity is ultimately going to be worthless.
That's well said.
Peter and I always would talk about, some of the DSO's marketing campaigns, because as practicing dentists, we get a mailer a week or at least 2 a month. And it's constantly like, are you sick and tired of running your practice? Do you want to go fishing more? Literally there was a graphic that was sent by a very large DSO. It was like the guy's half in scrubs and half fly fishing. So like what company would want to buy a business under the pretense of like, do you hate your business?
That's what I was saying.
The life out of you? Well, great. We'll buy it. You go fishing. We'll deal with all the shit. Like that's the craziest narrative ever. I don't want to invest in a company that has that as a narrative.
There are a couple that are set up because they've done a ton of those transactions to actually monetize that business, and they have that succession planning component in place, but they are few and far between.
Yeah, and they're buying, right? Like a doctor who wants to transact and walk away tomorrow is selling at kind of a fire sale valuation, right? I mean,
so they know what they're getting. Yeah,
they know what they're getting, right? It's baked into the model. But someone who wants to maximize value should expect to stay for 5 to 7 years. If you're wanting to squeeze all the maximum value from a transaction, you need to be expected to pay. Because to your point, Brandon, now you're going to have a investment partner, and you guys are going to hold hands for a while. right?
Yeah.
Because you've got alignment to win. And
Well, I think that's where DSOs have gotten smart, and private equity's gotten smart in our space, is focusing more on long-term alignment, and that's why we've seen the joint venture model, actually real retained equity at the practice level, either a hybrid or partnership model, where the doctor has equity at the local level. That has been, what's changed pretty dramatically over the past 5 years. Previous to COVID, most of the models out there were the traditional holding company model where the DSO is going to give you 70%, 80% cash at close, and then you're going to have stock in the parent company of the DSO. But in that scenario, you get that free rider problem where a lot of people are like, hey, I'll take the 80%.
Right.
I'll take a flyer on the other 20. I'm going to back off my practice, but it's not a big deal because I'm invested across all the assets in the portfolio. And as long as all the other doctors are working hard, I don't have to work hard. Well, guess what? A bunch of the other doctors,
everyone's thinking that,
the same exact way, and now the equity is worthless. So DSOs have gotten smart in knowing that they need to align incentives at the local level, and that's where that joint venture retained equity has come into play.
Hey, Brent, I want to ask you to look into your crystal ball like I usually do. What do you think the final, when this is all said and done, when the consolidation is complete, what percentage of dentists are consolidated, meaning working under a larger corporate structure or multi-location? So what percentage are consolidated, and when do you think that happens?
So I think we're 7 to 10 years away of seeing 60% consolidation. And I think
where are we now, according to what you
35,
know?
right?
No. So the statistics are all over the place. The
They all are.
The ADA just released data that says that we're less than 20% consolidated, somewhere around 15%. And I would actually agree with that number as opposed to these 30, 40% numbers. So one, it's hard to define, right? Are we talking about revenue? Are we talking about doctors? Are we talking about storefronts? The reality is that, 40% of the practices in the country have no EBITDA and therefore would never be acquisition targets of DSOs.
Did you say 40?
It's probably 35, 40%.
Oh, 100%. So the average solo practitioner, what I heard, has a gross revenue of around 700,000, 800,000.
Yeah, I'd say 800,000 is
there's no EBITDA there. There's no EBITDA there.
There's no EBITDA there. So a lot of it's still kind of a cottage industry in large degree with a lot of the solo practices out there that have no EBITDA, and I think that will continue. You can make a decent living doing $800,000-900,000 a year with you as the sole provider. So there will always be a component of dentistry, I think, that has that cottage feel. And then there are a lot of young entrepreneurial doctors that are starting practices and buying practices every day. A lot of people in Bulletproof are in that lane. So I think private equity DSOs want to pound their chest and say, we're taking over. We're going to be at 80% consolidation in 5 years. But that's because they have their own echo chamber that they live in. Whereas we understand, as also traditional practice sale brokers, we have a division of our company that does doctor-to-doctor practice sales. We'll do more this year than we ever have. We know that for every practice that's selling to a DSO, there's 1 or 2 doctors that are buying a small practice or doing a de novo and are going into ownership. So I would say that it's relatively even as far as the number of practices that are being acquired by private equity versus the number of entrepreneurial doctors that are choosing to buy or start a practice. That's why I think it's going to take 7 to 10 years to get to 60 to 65% consolidation. And even then, I think we're talking about revenue and doctors. We're not talking about storefronts.
That's great to hear, actually. And I do agree
I
with
have
that.
a counterpoint, by the way. Pete, go ahead if you don't mind. You agree with Brennan?
Yeah, I do. On the where we end up in totality and how long, but let me hear your counterpoint, Craig.
Well, my thought is that if we take the average practitioner, that $70,000-$100,000 guy or gal working in their own practice, creating no EBITDA, meaning no entrepreneurial profit, that person's salary is the average, what is that, 178 to 220, 240. When we look at the level of school rising educational costs and difficulty to borrow to open your own practice, and complexity of running a practice, and how it used to be, like, as I used to always say, a place to sit and a place to spit. Now it's like scanner, 3D printer, CT scan, student debt. I don't see the viability of what we're seeing in the market. I don't, like, if you look at average doc now, 800, 220 in salary, and then you take average graduate at 450, if they go to USC, 799. I don't see how this.
Suggest it. I certainly don't suggest to be in that lane. I think if private practice is going to survive or thrive long term, you've got to move towards the multi-doctor, multi-discipline model, right?
Right, but the average doctor is, so if the average doesn't change, how does the average doctor stay viable?
I think the average has to change, but there will be doctors out there that will live on $150,000 to $200,000 a year after paying their debt and their student loans. I don't want that to become the new reality. I do think we've already seen that the practices with 500,000 and less in revenue, and by the way, there were a ton of them out there up until 5 years ago, that those are dinosaurs. They're dying off. They're going through a mass extinction event right now, where if you don't do $800,000 or more, you really can't make a living in this business, especially if you're a younger doc, given the student loan debt, the lifestyle expectations, and the cost of starting, buying, and running a business. Over time, I think that threshold is going to have to go up. $1 million, $1.2 million, $1.5 million in order for it to be sustainable long term. But really, if you want to be in private practice and be successful long term, I think you've got to move towards that group practice model, multi-specialty model, emulate what the DSOs are doing, but do it, from a private practice perspective. And then also look at, we're seeing, I think right now, especially with Delta Dental, a lot of people moving towards more of a boutique out of network model. And I think that's a good thing potentially long term.
My last question to you was going to be something along those lines, like, because you have the optics, do you have advice for people who are maybe not in the camp of like, I'm wanting to do a transaction, but how do I start making me look pretty? How do I start what are some tips and tricks that you've seen? Maybe they're not tricks, but maybe what are some tips that you can give someone for a 3 to 5 year runway that says, hey, clean up this, do this, optimize for this technology. What are you seeing?
Yeah, I think so. First and foremost, if you are a multi-location practice owner, I would have each practice under your own entity, under its own entity, and potentially under its own brand. And
each location under a different entity?
Each location under a different entity, and be slow to utilize a DSO structure where, you establish a management entity and do all that. I don't think you need to do that until you get to 5 locations plus. We see a lot of people overcomplicate their financials and limit their optionality by combining everything, thinking that they're going to grow into this 25 location monster that's all branded the same under one entity and sell it, to private equity at some point. So there may be a point where it's appropriate to go that direction, but most of the people we run into, 3, 5, 7 locations, keep it as simple as possible and offer yourself as much optionality as possible, so that if you need to carve out a practice and sell it independently in a traditional sense, you have the ability to do that. Or if you want to carve out 5 of 7 and sell those to private equity and hang on to 2 others because they haven't reached maturity, or they just don't fit into the overall transaction. I think giving yourself as much optionality as possible is critical. And as Craig said, I think you need to look at yourself as an entrepreneur if you're going to go into business. You need to read. You need to develop relationships with people like you guys, with mentors, with people that have been there and done it and made the mistakes that you can learn from without making them yourself. And like we said earlier, build a real company, build something sustainable. Don't think that you're going to be able to flip it in 3 years, 5 years, 7 years, because the reality is market conditions change and we don't know exactly what the future looks like. I am bullish on the future going forward. You asked this question earlier, so I'll address it. What does the DSO private equity world look like in dentistry in 2025 and 2026? I'm hopeful that interest rates are going to cool off. Inflation looks like it's cooled off. So I'm hopeful we're going to see multiple rate decreases. They're going to be minimal, but they will send a positive signal to the marketplace and to private equity that they're not going up any further. So I think you're going to see a lot of recaps in 2025, but it's going to be a mixed bag. Those DSOs who were built for sustainability and done a good job of operating and generating same-store sales growth, they're going to recap at decent multiples, not 15, 17x. We're probably talking 11 to 13x. And the other DSOs that don't have a sustainable business model, that don't have real infrastructure, that can't exhibit same-store sales growth, they're going to be in trouble long-term. And they're going to have to continuously raise debt and refinance debt in order to make it and retool their organization. The reality is that in 2025, picture this. If you live in a neighborhood where every house in the neighborhood goes up for sale at the same time, we're about to experience that not just in dentistry, but in almost every vertical backed by private equity. Recaps have been muted or delayed for 2 years or better now. So almost everyone is nearing the end of a recap cycle, and they're all going to want to monetize their businesses over the next 24 months. In a crowded market where every house is up for sale in that neighborhood at the same time, only the best of the best are going to find buyers and are going to trade at multiples. And I think that's what we're going to see. But I'm bullish in the sense that I think you are going to see the macroeconomic environment, those conditions soften, become more attractive. You're going to see more and more private equity money flood into our space. The consolidation is going to continue, and you're going to see some healthy recaps of the healthy companies.
Well, one thing I want to add to Pete, if you don't mind, you said like, what Brannon, tell us how to get pretty, like how to make ourselves look attractive for that, 5-7 year window. What do I have to do today in order to start planning that process? And I want to add to that, when I look back at my career of dentistry for 25 years, there were times where I freaking hated my life. And those were the times that I most wanted to sell. And the reason why, if I'm being just completely honest, is the business did not work for me. I was doing things that I wasn't good at. I didn't have the right people around me, and I was miserable. So as I've optimized my business with the intentionality of potentially selling, I've actually started to really enjoy my business now. So you sell something you don't like, you fix it so that it's sellable, and now you love it again. So it's just an interesting way of looking at something. So no matter where you are in the cycle, you should start making it look good, because at the worst case scenario, you'll just love your life and you won't do a transaction. But I think it's important, if you don't like where you're at, fix it.
Right.
Because once you
that comes down to delegating, right? Delegate the things that you're not good at or that you don't enjoy, and also that how you value your time, right? I think as an entrepreneur, as a successful business owner, you need to understand what your time is worth. And if you're doing things that you shouldn't be doing, that you don't enjoy, and they're not accretive from a time value perspective, they need to be delegated. They need to be outsourced. There's likely somebody that can do it better, do it cheaper, that enjoys doing it. And that's the way that you really scale a meaningful business. And then know your EBITDA. Pete, you pointed that out at all times. Know your EBITDA. So that's where we would love to enter the conversation, to develop a relationship early, to educate you about what drives value, what your business is worth today, and how do we re-engineer the outcome that you ultimately want. And if that means you want to own the business for 20 years, or you're looking to monetize it in 5 years, 6 years, 7 years. So please reach out to us if we can help. Again, I'm Brannon Moncrief, Principal CEO, McLaren and Associates. And I think people are always think I'm crazy for giving out my contact information on a podcast that's got such a large viewership, but I'll do that. You can text me, call me, 512-660-8505, or email me, Brannon@dentaltransitions.com. Appreciate you guys having me.
I think that's smart. I'd give myself an all over the place too. I think that's good, buddy. Good for you, man. Good for you.
Yeah, Brannon, always great listening to you. You have such a unique perspective on this, and I know your heart's in the right place. So excited to have you here with us. And dogs going crazy, but sorry about that.
All right, Brannon. Thanks again, buddy. We'll talk to you later. Thanks, everyone. We'll see you next time.
Bye-bye.